All right, good afternoon. Welcome to Real Talk Weekly. This is Badan and Josh. We're talking about our recent investor night, which was a great success. Over 100 people RSVP'd, and we had a busy time. And we'll be today breaking it down and sharing you all the pointers. Stay tuned. All right, here we are. How's the day been for you, Josh?
Yeah, good.
Busy?
Monday always start off strong, and we're here doing Real Talk Weekly.
Very much. It's a chaotic week, chaotic day. I
Yeah,
think it's
yeah.
a good way to segue into this. And what better than our recent big event we did here last Thursday, called the Novak Investor Night.
Yeah,
It was a good event, right?
yeah. Solid turnout. We're at, from we started at 6, finished at 8. Like Bidan said, we had close to 100, over 100 people come in and visit. Some really cool talkers, and we want to discuss a bit on those topics tonight. And in case you missed it, there is a recording out there as
Yes.
well that we can reference if you want to watch the full presentation from last Thursday. But we just thought we'd go quickly through probably some of the biggest points we thought or took from the night. So in terms of speakers, you had Mark, Lisa was hosting, then you had, I think it's Bradley Beer, is it?
Bradley Beer from
Yeah,
BMT.
BMT depreciation. So we'll go through on a few points there. And then we had ZM Partners, Maurizio. Yeah, Maurizio.
Really good with numbers.
Very smart guy, and he had some discussions from an accountant's perspective around obviously new capital gains discounts, negative gearing, off the plan property, et cetera, et cetera. So we thought, you want to start off with depreciation bids.
Very much.
It's probably something that's left under the rug, but from looking at it, there's some big claims to be made.
A lot. And people are actually surprised when Bradley kind of broke everything, all the numbers down and see how much they're actually leaving on the table, how much they could be taking home. So before I get in there, as Josh mentioned, there is an online video of that event night, which is in our social media platforms. And there were slides that were used that had the real numbers. If you want those slides, all you have to do is text budget or unlocked in the number 0460 111 If you text budget or unlocked at 0460 111 you will get all those slides prepared by the speaker, so you can listen to the video and go to the slides as well. Now, coming to the event, I think it was a very informative event, like for us being in day out. There are some simple things that will help us help our investors and landlords and day to day how we meet people. And the most important part is depreciation. And now the government as well focusing more on the new builds. There's so much to claim. They recently finished one here in Havana, 8 Oaks Avenue, and they created a very realistic depreciation numbers. And in a brand new 2-bedroom unit bought for 1.3 million, the depreciation in the first year was close to $17,000, which is a big number.
Massive.
Right. And if you don't do it right, like there are things where you just do the numbers just go the normal way, not being clever with numbers and what to claim, what not to claim, which of course your accountant would know. Us as agents, we're just there to let you know, hey, this can be done.
Yeah, fantastic.
Simple things like that. And also not just brand new. What Bradley mentioned is that most people, when they buy in an old property, 70s, 80s built, they just raise their hand saying my property is too old, nothing can be claimed. But there's still some money left there to be claimed.
I think it's built after 87.
Yes,
87.
very true.
Yeah, anything built after 87, there could be deductions there that you haven't made already.
Exactly.
And you can make past claims that you're up to date with.
Very true.
And we're talking about the brick and mortar guys. So although your property value goes up over time, the tangible, your brick and mortar, that's the stuff that depreciates. And that's what you take into account. I think it's around over an average of 40 years, you're probably getting an average 2.5% claimer on the building itself.
Sure.
Yeah, so very important. And with all the negative gearing coming out of the market, you try to make any deductions you can.
Very much.
But some benefits there still to brand new, obviously.
Very much. With brand new, quite a lot. Like as mentioned in Bradley, the slide did mention like what a normal breakdown would be of your normal what do you call depreciation estimate versus when BMT or your accountant does it right. There was closer to $3,000 to $4,000 difference in between those two. And what really caught me off guard, Josh, was when you mentioned if before renovation,
Yeah, this is a good one.
if you're doing a kitchen renovation, all those cabinets that are already there, those could be part of your depreciation as well.
Yeah, and then you depreciate the brand new ones right after.
Exactly. That was like the biggest plus point, and I think it took a lot by surprise as well what could be done there. So on the slides, everything is mentioned there, like what's our long-term depreciation items versus short-term. Everything is in there, and I think you should take advantage of every little thing because you are paying money for all those. And you get taxed for 100% of your income anyway. So why not take the best out of it? Squeeze every drop.
Exactly,
Right.
definitely, guys. BMT, they're actually fantastic. Bradley's a great speaker.
Yeah.
Knows his stuff. I think he's
Very much.
what 30, a couple long time. Put it that way.
30 plus years.
Yeah. So really experienced. They've got a really good team, and something even I, as a been living and breathing property every day. Something even shocked me in regards to what's on the table there, and to ensure you, like you said, it's you get every drop because it matters. So the government doesn't miss you on any charges or taxes, so it's your obligation to do the same with these sorts of things. Then we had so that was fantastic with depreciation. And massive in your first 7 years. I think it was 18 to 25 grand as an estimate in your first year. So massive there with depreciation. Sit down, have the question, speak to an expert is how we close that one off. But definitely untapped potential. Then we had Maurizio from ZM Partners, accounting. Obviously, the big ones around discussion here was what is the definition of brand new, first owners in that circumstance, negative gearing, what property does it affect, what doesn't it affect? Obviously, it's all existing residential property purchased after the budget night, 7:30 p.m. budget night. However, there is exceptions for brand new off the plan and commercial, so they came up on tops in regards to negative gearing. I'm slowly starting to see that in the marketplace, early signs of commercial buyers really picking up. So feeling the volume there. Another thing as well, which I think people were waiting for an explanation to or a confirmation, because there's been a lot of people making their own opinions on this topic. But another big thing I thought was massive, off the plan, you'll retain the existing or the previous structure of a 50% discount on your capital gain after 12 months. So I think that's massive. I mean, if you're holding property for longer periods of time, let's say 10 years, generally property doubles every 10 years in the Northern Beaches. So you buy a unit for $1 million, and then in 10 years time, you're selling for $2 million. Means you're getting taxed on 500 versus 700. So a good $200,000, massive. And should, if you're looking to, well, it depends on what, obviously, your goal, your property goals. But if you're looking to acquire and hold these assets into the future, 20% margin is massive. So that was quite revealing. A lot of the people out in the crowd started all of a sudden thinking about off the plan property and coming up and speaking to us after. And I guess the problem there is the supply. Great to have these advantages on off the plan property. But the supply on places like the Northern Beaches, eastern suburbs, there's either no supply or you're paying extremely high rates. And they're thinking that this saving you're going to make in the future will give the investors the reason to pay these higher rates. And that's underpinned by construction costs, which we've spoken about in detail throughout this podcast. So some pretty big points there in regards to negative gearing, capital gains discount, minimum being 30% tax rate on your capital gains. What else is there? There seems to be some movement lately with the Labor government. I know they're making changes to small businesses on capital gains discounts. So they're increasing the thresholds from 2 million to 10 million. So that will help startups, things like that. But whether or not, and I think they're going to have a discussion around the trusts. So stay tuned on the trust and how that's taxed. I believe there's further discussion being made there. So maybe some changes, because I think it's not until obviously the Senate passes these policies does it come gazetted or come into effect. So I thought they were really, really big changes, and people obviously talked about structures. What are you purchasing in? Self-managed super funds. There was some comments by Maurizio around, not necessarily just jumping to company structures or self-managed super funds. There needs to be some level of risk management, especially when it's your super and you're depending on that in your later years. So again, topics around that were speak to your accountant, speak to a professional, get an idea. One thing I definitely thought hit home from Maurizio, and definitely something that I am getting out to all my landlords that are looking to hold property post July 2027 is get a valuation done.
Oh yeah, that was a big point.
Get a valuation done, guys, because with this capital gains and how it's going to be calculated is so your capital growth from when you purchase the property up until the change in July 2027, that growth there will be based upon the previous policy, so 50% discount on the gain. Now, what will happen is from July 2027, any growth beyond that point will then be under the new system. So if you're not getting valuations in place, you're leaving it up to the ATO to determine the value of your property at that time, and that's something I wouldn't advise whatsoever. So he also said don't leave it till last minute, because with demand and the same amount, it's not like we're going to get a rush of valuers in the next 12 months. So timing and pricing will factor as we get closer to that date. So he said get a good reputable assessor to come out and do that valuation. That's probably one of the biggest things that took from the night from Maurizio for existing landlords. So definitely hit home there.
Yes, anything to share more on that as well? That was my biggest takeaway. Just get the valuation done, because you get grandfathered, so from the previous months. Let's say we bought a property in 2020 until 1st of July 2027, they will be calculated from the previous rules. And the only way to know what your property was worth before 1st of July 2027 was to get a right valuation done. You still have a year's time, literally from now. It's 22nd of June now, so you have 1 year time. As close to it as possible, just get a valuation done whenever. That was the biggest.
Definitely
one of the biggest takeaway. And Mark was one of our other speakers. He did mention about how super. We love those numbers, and Mark especially loved those numbers. Like we talked about how DOI has done, how Northern Beaches has done in the last 10 to 40 years, and from all that data, we just can predict that rental markets are going really high up, and the strata units will perform really high as well very soon, according to what Mark Sada has performed there. And super, as always,
houses to sort of flatline.
Yes, flatline. That's true.
Flatline. And there was a pretty good question from the audience in regards to sort of two markets in one when it comes to the unit market, because I guess this probably affects that market more so, and that's your tenanted investments. Are you selling to an investor versus an owner occupier? And I'm definitely seeing this in the marketplace. Your investors seem to have either left the market or take their time to make a decision currently, so you've got a less competitive campaign. So I really think if you've got a tenanted property and you're looking at putting it up for sale, be patient, wait. It's probably the best decision to move your tenant out, make updates if they're needed. So in the terms of renovations, lighting, paint, if you're wanting to achieve the best result on a unit sale, your buyer is going to be an owner occupier, and then you are competing with the existing stock on the market. So I think renovated product, accessibility, because you want to be thinking of your downsizers that don't want to be doing stairs. I think they're massive things in the market now, and I'm definitely seeing property that hasn't had the love per se because they've had a lovely tenant in there over the last couple of years. Those properties seem to be on market longer
Mhm.
and struggling in terms of price performance. So definitely two sort of segments in the market. You want to be presenting that property to an owner occupier. That's definitely what I've taken out of the recent changes in buyer activity. Commercial on the way up, and then self-managed super funds. I did a topic on this last week. I think we've gone from about, I think it was $13 billion in the last 12 months has been transferred over into self-managed super funds. At an average super fund of around 188,000, that's 189 applications a day for self-managed super funds.
Yeah.
And they've grown from 10% of your traditional super being transferred in the previous 12 months. That's now jacked up to about 17%.
17.
So you've almost doubled the amount of people year on year taking up self-managed super funds and wanting a bit of control in regards to their future. But yeah, big changes. I think if we recap over what we've spoken about, valuations off the plan property seem to be the way to go if you're looking to, excuse me guys, my apologies, if you're looking to grow your portfolio bids.
Yeah, pretty much those are the main things. And depreciation, not to forget at all. Like
Definitely.
make sure you're claiming every single dollar out of them, because you get taxed every single dollar per income. So it has to work both ways. And just ask your accountant the right question. They will be the one doing all the work. We're just the one making sure you do it. And if not your accountant, get a second one. Get someone who knows what they're doing. So because at the end of the day, it's what money comes into your pocket.
Definitely. And guys, like we said, if you want to relook over that that presentation, text 0460 111
The board.
budget.
Yes.
Budget, and you will have that presentation to view. And there's some leading experts in industries talking there. So definitely information worthwhile, and everyone that attended seemed very happy with it all. And
they're asking when the next one's going to be, right? Like, so
exactly.
It was a good event.
And guys, yeah, if you're wanting to find a little bit more, of course, always reach out to Vedant or myself. Happy to help. Thanks for tuning in tonight. Hope you grab something from it, and have a lovely week.
Cheers. Have a good day.
See you guys.
Have a good night.